There are two families on the same street in Columbus, Ohio. Both earn about $95,000 a year. Both have 2 kids, 2 cars, and a mortgage. One family will retire at 58 with over $1 million in net worth. The other will be 67, still working, with less than $80,000 saved and a knot in their stomach every time they check their bank account. Same street, same income, same economy. Completely different financial futures. And the difference isn't luck, inheritance, or some secret investment. The difference is 5 quiet decisions one family made that the other never even considered. My name is Rio, and on this channel, I break down the real psychology and math behind how money actually works. Today, I'm going to show you the brutal truth about how middle-class families actually build wealth. Not the version you see on social media, not the version financial gurus sell in courses, the real, boring, uncomfortable version that nobody talks about because it doesn't look impressive. But it works, and the math proves it. Let's start with the thing that makes most middle-class people feel stuck, even when they're earning good money. It's not that you don't make enough. It's that your expenses expand exactly as fast as your income. Psychologists call this hedonic adaptation. The financial world calls it lifestyle inflation. And it is the single most powerful wealth destroyer in the middle class. Here's how it works. You get a raise, let's say $5,000 a year. Within 3 months, your spending has absorbed every dollar of it. A nicer apartment, a better car payment, slightly more expensive restaurants. You didn't plan to spend it. It just happened, and it happens every single time. Bureau of Labor Statistics data shows that households earning between $75,000 and $100,000 spend 93 cents of every dollar they earn. 93 cents. That leaves 7 cents for building wealth. 7 cents out of every dollar. Meanwhile, households earning the same amount who intentionally control lifestyle inflation save and invest between 15 and 25 cents of every dollar. Same income. Completely different trajectory. Over 20 years, at 8% average returns, the difference between saving 7% and saving 20% of a $95,000 income is the difference between $152,000 and $435,000. That's not a small gap. That's the gap between anxiety and freedom. And it was created entirely by one decision, whether or not you let your lifestyle eat your raises. Here's the rule that quietly wealthy middle-class families follow. When your income goes up, your visible life should stay exactly the same. Every raise, every bonus, every unexpected windfall, 50% goes directly to investments before you ever see it. The other 50% you can split between lifestyle and short-term goals. But that first 50% is non-negotiable. It disappears into your brokerage account or your retirement fund before your brain even registers that you got paid more. This is how you break the hedonic treadmill. Not with willpower, with automation. You cannot spend money you never see. Now here's where the middle class gets wealth building completely backwards. And this is the part most people don't want to hear. The middle class obsesses over income. Wealthy people obsess over assets. Income is money that flows through your hands. Assets are things that put money into your hands while you sleep. And the uncomfortable truth is that most middle-class families spend 30 years building someone else's assets instead of their own. Your mortgage payment builds equity. That's an asset. But your car payment, your furniture financing, your subscription stack, your upgraded phone every year, those are liabilities disguised as lifestyle. Every dollar flowing toward a liability is a dollar that could have been buying an asset. Let me make this concrete. The average middle-class household spends about $750 a month on car payments. 2 vehicles, maybe one at $400 and the other at $350. If instead you drove paid-off cars and invested that $750 monthly at 8% returns, in 20 years you'd have $441,000 just from car payments. That's not theoretical. That's the actual math. And that's just one expense category. Now, add in the $150 a month in subscriptions most households carry. The $300 a month in dining out above what's reasonable. $200 a month in impulse purchases. You're looking at $1,400 a month in spending that produces zero long-term value. Invested. Instead, that's over $800,000 in 20 years. The middle class doesn't have an income problem. It has an asset allocation problem. The money is there. It's just flowing in the wrong direction. If this is making you rethink how your money moves, take 2 seconds and hit the like button. It really helps the channel. Let's talk about the wealth-building vehicle that the middle class has access to, but dramatically underuses employer-sponsored retirement accounts. If your employer offers a 401k with a match, and you're not contributing at least enough to get the full match, you are literally declining free money. The average employer match is between 3 and 6% on a $95,000 salary. A 4% match means your employer hands you $3,800 a year for doing nothing except saying yes. Over 25 years, at 8% returns, that employer match alone, money you didn't earn, didn't save, didn't sacrifice for, becomes approximately $296,000. Just the match. Now add your own contributions. If you contribute 15% of your salary, about $14,250 a year, plus the match, you're putting over $18,000 a year into investments. Over 25 years, that becomes approximately $1.4 million on a middle-class salary. No stock picking, no real estate empire, no side hustle grind. Just consistent contributions to boring index funds inside a tax-advantaged account for 25 years. This is how the middle class actually gets wealthy. Not with a viral moment, with a direct deposit that never stops. But here's the psychological trap. $1.4 million in 25 years doesn't feel urgent today. And that's exactly why most people don't do it. The human brain discounts future rewards at an irrational rate. $100 today feels more valuable than $300 in 10 years, even though mathematically that's an absurd preference. This is called hyperbolic discounting, and it's the cognitive bias that keeps the middle class middle class. Wealthy families override this bias with systems. They don't rely on motivation. They don't rely on discipline. They build automatic structures that make wealth building the default, not the exception. Direct deposits into investment accounts. Automatic escalation of contributions every year. Spending accounts with hard limits. The money moves before you make a decision because decisions are where wealth goes to die. Now let's talk about the one move that separates middle-class families who build real wealth from those who just get by owning assets that generate income. Your house is an asset, yes, but it doesn't put money in your pocket every month. It actually costs you money maintenance, taxes, insurance. The wealthy middle class owns at least one thing that pays them: a rental property, a dividend portfolio, a small business, an intellectual property stream, even a high-yield bond ladder. Something that generates cash, whether you show up to work or not. Here's a realistic example. A middle-class family saves aggressively for 3 years and puts $60,000 down on a $200,000 rental property. After mortgage, taxes, insurance, and maintenance, that property nets them $400 a month in cash flow. That's $4,800 a year in passive income. But more importantly, over 15 years, that property appreciates, the tenants pay down the mortgage, and that original $60,000 investment becomes a property worth $320,000 with a remaining mortgage of $80,000. That's $240,000 in equity, plus $72,000 in cumulative cash flow, all from one decision made once, managed on weekends. Meanwhile, the family next door spent that same $60,000 over 3 years on vacations, a kitchen renovation, and a boat. The money's gone. No equity, no cash flow, no compounding. Same $60,000. Radically different outcomes. And if you're getting real value from this, consider subscribing. I make videos like this every week breaking down what actually works in building wealth. Here's what I want you to do starting this week. 5 moves, all actionable, all specific. First, calculate your true savings rate. Take your total annual income, subtract your total annual spending, divide by your income. If that number is below 15%, you have a leak that needs fixing before anything else matters. Second, automate 50% of your next raise into investments before it ever hits your checking account. Call your HR department or log into your retirement portal and increase your contribution the same week the raise starts. Third, eliminate one monthly payment that funds a depreciating asset, one car payment, one financing plan, one subscription stack. Redirect that exact amount into a brokerage account. Fourth, max out your employer match immediately. If you're not getting the full match, you're leaving thousands on the table every year, and those thousands compound into hundreds of thousands. Fifth, start researching one income-producing asset you could own within the next 24 months. A rental property, a dividend portfolio, a small online business. Give yourself a target and a timeline. Now let me take you back to that street in Columbus. Same houses, same incomes, same economy. The family that retires at 58 didn't do anything dramatic. They didn't get lucky with a stock tip. They didn't start a tech company in their garage. They captured their raises before lifestyle inflation could eat them. They maxed out their employer match for 25 years. They bought one rental property in 2012 when everyone else was still scared. They drove paid-off cars and invested the difference. And they never once posted about it on social media. The family, still working at 67, made good money their entire lives. They just let it flow through their hands instead of building something with it. They chose visible comfort over invisible wealth. And by the time they realized the difference, compound interest had already made the gap nearly impossible to close. The brutal truth about how the middle class gets wealthy is that it doesn't require brilliance. It requires consistency, automation, and the willingness to let your life look ordinary while your net worth becomes extraordinary. The strategies aren't complicated. The math isn't hidden. The only thing standing between you and financial freedom is whether you'll actually make the boring moves that build real wealth or keep waiting for something that feels more exciting. Your money is moving somewhere right now. The only question is whether it's building your future or funding your present. And that's a choice you make every single day. What's the first move you're making? Drop it in the comments. And I'll see you in the next one. Thanks for listening.